Hi, this is Terry. I'm going to get you started here with some Chapter 15 lecture notes. This is for the Needles textbook. And the first thing I want to point out is that we're just going to cover major concepts in these videos. You have to read the chapter. You really want to read the chapter to get all the details, and I'm not necessarily covering each and every point. So just as a reminder, the traditional classified income statement starts out with a heading. It's sales minus cost of goods sold is gross margin or gross profit, minus operating expenses gives us net income. So sales minus the returns gives us net sales. Then the cost of goods sold section is beginning inventory plus our net purchases. So purchases minus returns minus discounts plus freight in gives us our net purchases. So beginning inventory plus net purchase gives us goods available for sale minus ending inventory then gives us the cost of goods sold. Once we have the sales and we have the cost of goods sold, we do gross margin or gross profit. Again, taking away all the operating expenses then gives us net income. If we move further down, then when we look at a classified balance sheet, then that is our assets equals liabilities plus owner's equity. Our assets would be things like, let's kind of, put those in line there. Cash, our assets would be our current assets would be cash, accounts receivable, merchandise inventory. So these are all assets that are going to be converted into cash within 1 year or one operating cycle. Then you have your long-term assets such as property, plant, and equipment minus the depreciation. This is a simplified version, so it doesn't have any intangibles or investments. Then when we look at our liability section, our current liabilities are bills that we're going to pay within 1 year or one operating cycle. Again, this is a very limited example here, so there's no long-term liabilities. Then our common stock, PIK, and retained earnings. So when you add the total liabilities, you add the total owner's equity, you get the total liabilities and owner's equity, which has to match your total assets. All right, so all of that should be just quick general information from your financial accounting. The next issue is then we need to keep track of this. And if we kind of come up here for just a second, what we're going to do here in the future with managerial accounting is we're purchasing inventory. So the merchandise inventory here is what we've purchased from other companies. That's not what we're going to do, because what we're going to do is make the product. So this purchases will be replaced with cost of goods manufactured. And our beginning inventory here will not be the merchandising inventory, it'll be the beginning finished goods inventory. So you're going to see this when we get down a little bit lower on this handout. And here on the balance sheet, again, in a retail or merchandising situation, then we only have the one inventory account. And as what we're going to see right now is we actually have three inventory accounts: materials, work in process, and finished goods. And the materials goes to a physical location that we have a warehouse where we bring all of our raw materials in. If we're making a little red wagon, we're bringing in sheets of metal, drums of red paint, pipe to make the handle. We might buy some pre-made wheels. All of those go in the warehouse. So we're going to show that in the materials warehouse. Then the factory itself is going to be the work in process. So that's where we're going to bring the materials in. We're going to run it through the different sets of machines. And then when we get all done, we will move it from work in process to finished goods. So we'll have this all out in the warehouse so that when we sell it, we can ship it. At this point here, these three inventory accounts, they're inventory accounts, first of all, and they are ledger accounts. These are not expenses, is the point. They are assets, they're inventory, and what we're doing is getting a product and making it more valuable through the manufacturing process. At the point that we get them completely done and sell it, then we're going to take that asset that we give up and convert it to an expense called cost of goods sold. At the same point in time, when we take it out of inventory and make it an expense, then we'll make a second journal entry to record the sales and how they paid, whether it was cash or accounts receivable. So if we look at this in a little more detail, and this is from the Garrison textbook, what we're going to do is we're going to debit into the raw materials anytime we purchase materials from purveyors. So this is everything from, again, our little red wagon, everything from the metal, the pipe, the pre-made wheels, all of those kind of issues, plus rags to clean up, cleaning materials, grease for the machines, anything that we need in the manufacturing environment. This is different than supplies. All right, sorry for the transition there. A bunch of emails came in, so I had to do a little switcheroo here. The raw materials where I left off here, raw materials are what we're going to use in the manufacturing of the product and are not supplies. Supplies are pencils and pen and things used in the sales and the administrative offices. Once we've bought these materials, then we're going to make journal entries to move them to the factory. So if we go back up here, again, they're going to come out of the warehouse and go into the physical factory. So out of the materials into work in process. The work in process is the factory. So the materials that are traceable and worth tracing, such as if we use our little red wagon, that would be the metal, the drums of paint to paint them, the pipe to make the handles, the wheels, the little caps to hold the wheels on, all of that kind of stuff. Those are direct materials, and those direct materials then are traceable and worth tracing. We also have other materials that will come out of the materials account, but we're going to put them down here into overhead, and those are materials that are indirect, such as grease for the machines and mop heads so that we can mop around the place, and spray cleaners so we can keep everything clean. The issue there is they go into the manufacturing of the product but are not there on a physical sense. You can't walk up to the little red wagon and find a mop head. So they go into manufacturing overhead. So to move that, we'll see the journal entries in the next video, but what we would do is we debit work in process for the value of the direct materials. We debit overhead for the value of the indirect materials, and then credit the materials account for whatever we took out. The salary and wages payable are pretty much the same thing. Again, if we slide down here, we have direct labor and indirect labor. Direct labor is anything with a hands-on sense. So the factory worker that is making the product is direct labor. The supervisor walking around is indirect labor. So if we go back up here, our wage and salaries payable, we would debit work in process for the direct labor. We would debit the manufacturing overhead for the indirect labor, so direct labor, indirect labor. Then if we had we were also doing the billing for the sales office and the administrative office, then the third debit would be to wage and salary expense. So the people that work running the sales office are expenses, but the people that work in the factory are direct labor and indirect labor. And then the credit for all three of those categories would go into the salary and wages payable, recognizing that payable is going to go on the balance sheet. Agree? Then we have a little problem with this overhead, and we'll get deeper into that, but for right now, understand that that overhead is a temporary account. So we have our three product costs: materials, labor, and overhead, that go into work in process. We're going to debit manufacturing overhead for all the actual costs, and in the next video we're going to see how do we take the money out of that overhead cost and put it into work in process. And we're going to use an application rate. Again, that's in the next video. Once we get all three of our materials, labor, and overhead into work in process, and now the product is done, we move it out of the factory and put it into the finished goods warehouse. So we're going to move it out of the factory, from the materials into the factory, out to the finished goods warehouse, out to the finished goods warehouse, and then it's going to sit there. So at this point, these are called inventoriable costs. They are not expenses. By FASB rules, you cannot have an expense if you don't have a revenue. And at this point, we haven't sold anything. And what we're doing, if you think about it, is we're taking raw materials and we're making them more and more and more valuable. When they have the most value is this little red wagon in a box ready to go to the toy store. Then when we sell them, we're going to give up an asset. We're going to give up inventory, which is an asset. And what we're going to do is transfer that as an expense to us. Just like we're going to buy ready-made shoes in a merchandising situation, shirts, clothes, coats, and all that. Then that goes from inventory, and then when we sell it, it goes to cost of goods sold. At the same point in time that we sell it, then we'll make another journal entry that records the debit to accounts receivable or cash, however they pay us, and a credit to sales. So we move it, the inventory, to the expense, and then also record the revenue and their payment method. So again, just a couple more quick to go through this little model here. All our manufacturing costs, which are also called product costs, are materials, labor, and overhead. And it gives a description. They also call the materials and the labor the prime costs because they're traceable and worth tracing. And then when you take labor and overhead together, then those two are called conversion costs because it's the costs that you incur converting the materials into a usable product. The other costs now are called non-manufacturing. They're called period costs or selling and administrative costs. All right, so here's our sales. Then there's our cost of goods sold with the beginning finished goods, our cost of goods manufactured. We'll subtract out our ending finished goods, have to put in our over/under applied overhead, which we'll talk about next chapter or next video. And so we have sales minus the cost of goods sold is gross margin, minus our operating expenses is net income. So this terminology has just changed a little bit in this cost of goods sold section. And to support this number, the 650, instead of this being our net purchases, again, this is what we manufactured, not purchased. So we have a cost of goods manufactured, which is our materials, our labor, and our overhead, right? And when we add them together, we get our total manufacturing costs. To figure out how much it cost us to manufacture for this period, we have to take the other two inventory accounts, the materials account and the work in process account, and add the beginning balance, subtract the ending to capture any changes in the dollar value that was in those accounts at the beginning to the end of the period. So the cost of goods manufactured can be higher than the manufacturing costs or lower than the manufacturing costs, right? The cost of goods manufactured could be higher or lower than this number depending upon whether the work in process or the amount of unfinished items in the factory, how much was there at the beginning versus the end. Alright, I hope this is helpful. It's kind of hard to explain, but hopefully by the time you see the video and walk through the chapter, read the chapter and then do your homework, this will all make perfect sense. A couple quick little things. We'll just scroll back up here. There's also the concept of variable cost and fixed cost. Variable costs change in total. So the example that they give here is if you're going to make a microwave oven and want to put a timer in, then with one oven you'll spend $30 because the timer costs $30 a piece. But if you make 200 ovens at $30 a piece, that's $6,000. So the more ovens you produce, then the more the costs go up. That's direct materials and direct labor. Then, and variable overhead, by the way. And then your fixed cost will be your fixed overhead, and those are items like property taxes, insurance. And if you make one oven, you're going to pay $9,000 for insurance for the month. If you make 100 ovens, doesn't matter, you're still only paying $9,000 for insurance. So these costs remain constant. So if you had to graph that, the $9,000 would be constant. Doesn't matter whether you make one oven, 100 ovens, or 200 ovens, or 1,000 ovens. If we are talking about the timing mechanism, if we make no ovens, we need no timers, so it goes through the vertex, and then the cost goes up. The more ovens, 100 ovens will spend $3,000, 200 ovens will spend $6,000. So if you go up, right, and plot that, ching ching right there, go up and across and plot that right there, right? Then you have that line, so you'll know that this is your variable cost, these are your fixed costs. And then the last concept is when we go to do some forecasting, we'll talk about the relevant range, and we're saying that our microwave's costing us $9,000 a month, from anywhere from 1 to 200 microwaves, because 200 microwaves might be our capacity. If we can't make more than 200 microwaves and we have to resort to another building, then of course our insurance is going up, because now we'll be paying insurance on 2 buildings, not just 1. So we always say, here's our forecast, blah blah blah, here's the numbers, as long as we're in our relevant range.